Welcome back, guys. Today we will be talking about Alibaba stock. We'll be talking about the recent dip it had of around 10 to 15%. We'll be talking about whether or not I'll be buying this stock. So let's get started. So as we can see today, Alibaba is up around 1%. It's up around 5% in the week. It's down around 10% the one week chart, and is down around 16% in the 3-month chart. And as you can see on the year, it's up around 10%, which is well below the S&P average of around 16 to 17%. So as we can see, Alibaba was trading near 310, and then it dropped around to 220. So why did Alibaba drop $90, even though it's one of the more prominent stocks in the NYSE? So for people who don't know, Alibaba is the second biggest online e-commerce website behind Amazon. They provide online and mobile marketplaces in retail and wholesale trade. Their biggest consumer is China. They are a Chinese-based company. The founder is Jack Ma, one of the richest people in the world. They also provide cloud services, large-scale computing, security management, and other innovative stuff like Alipay, AliExpress, and Ant Financial. So I would say Alibaba is the Amazon of China. It's almost exactly what it is. They provide everything that Amazon does, but to Chinese and Southeast Asian consumers. So there are three main news reasons why Alibaba has dropped and why I think it will bounce back to all-time highs. So let's take a look at these news articles. The first piece of news is the most important piece of news. It's that Alibaba has an antitrust lawsuit against it from the CPC, or better known as the Chinese government. So this is basically an antitrust probe into Alibaba's e-commerce business, and it says that the exclusive deals that Alibaba signs, that makes it signs its merchants, is illegal, and it's kind of like a monopoly, which is kind of hypocritical, saying that the CPC, the Chinese government, is trying to block monopolies, even though the government itself is a huge monopoly over everything it does in terms of commodities or various assets. However, I think this is very, very like it's too. The drop is very unjustified, because the worst punishment that can happen to Alibaba is that the government takes 10% of its profit sales for 1 year, which equates to around a 4% drop maybe in the stock, but it's already dropped 20+% from all-time highs. But I think the more important issue is Ant Financial, Ant Group. I believe 2-3 months ago, Alibaba stopped Ant Group from being a publicly listed company in the Hong Kong exchange, saying that Alibaba has too much control over various products in China and Southeast Asia, and they're basically becoming a monopoly. However, I don't think that's the case. And even if it is, the worst punishment is that 10% of sales in 1 year, which is not bad at all. While this lawsuit was kind of expected, I think this is more of a political stance rather than a basic monopolization, because as you know, the Chinese government really want everything in their grasp, and that's what we're going to talk about in the next section. So the second piece of news, which I thought was very important and why you should continue to buy this dip, is that Alibaba stock buyback plan is moved to 10 billion rather than the original 4 billion. And this was announced, one day after the stock sank 14% one day. So this gives me enough confidence that Alibaba management and Alibaba itself believes that their stock is undervalued and they should keep buying it more. So as I said again, the repurchasing program from 6 billion to 10 billion. However, shares still sank in Hong Kong trading. So one thing that's quite interesting is that different exchanges for the same stock vary completely different in prices. Let me get an example. The US right now, the US and the European markets, they lag in stock price in comparison to the Hong Kong stock exchanges because if a delisting were to happen, it would affect the United States stock market and the European stock market. So there's less risk if you were to invest in the same stock in Hong Kong because there would be no delisting in Hong Kong, as China considers Hong Kong part of China. So therefore, they wouldn't delist it from their own stock exchange. And so that makes it also very, very interesting. And one thing I like about the stock buyback program is that the CPC did approve this. So most of these stock buyback programs have to go through the CPC or the Chinese government, and they approved it, so meaning that the Chinese authorities don't think that Alibaba stock is going anywhere. So as you can see right here, the Hong Kong exchange in 9988 is up significantly more than what we saw, today in the U.S. markets. They might not have an exact bearing, but I have seen that, the Hong Kong 9988, which is Alibaba in the Hong Kong Stock Exchange, moves much more positively and less negatively. So meaning that when Baba sank 14% here, it only sank like 8% over there, and Alibaba moves 2% in the US, the upwards direction. Hong Kong may move 4 to 5%. It's quite interesting if that affects how you purchase it. So now let's talk about the last piece of news on why you should buy the dip. So the last piece of news, which I think is pretty important as well, is the relationship between the founder of Alibaba, Jack Ma, and the Chinese government. So if you all don't know, the Chinese government is a communist regime, and communist regimes like to control everything. Even though the Chinese government itself allows a lot of capitalistic mindsets, like free business and will and stuff like that, but in reality, they're more interested in how they can benefit financially in the situation. So I would say, China is not a true communist regime, but however, they are not afraid to step in any big company's turfs and say what they want to say or use any rules they want to impose. But in the United States, that's not how it works. There's due process. There's specific hoops that you have to jump in order to call, these big tech companies for a meeting or for a Congress hearing. It takes months and years of due diligence and preparation in order to file any sort of complaint or any sort of cross questioning. But in China's case, let's go ahead and make a phone call to Alibaba or just do a probe immediately. There's nothing like there's no checks and balances. If President Xi wants something done, they will get it done immediately. So that's the risk, when you invest in Chinese stocks. That's why you see, some stocks which are very similar to their American counterparts trading at much lower valuations. Alibaba actually, makes a lot of revenue. It's comparable to Amazon, and their margins are really good. But why is it only worth 500 billion? Amazon's around 2 trillion. It's because of the Chinese factor. China, there's always a risk. Yeah, oh, China might delist it or China may take away their profits or this and that. So there's always a risk, but it is justified why they have lower valuations. So I just want to talk about the basic relationship between Jack Ma and the CPC and what the Chinese government does for certain companies and why Alibaba, I think, is favored by the Chinese government. In order to create wealth in China, for big businesses, you have to be friends with the Chinese government. And I think Alibaba and Jack Ma have a terrific relationship. You don't become the biggest e-commerce platform in China by just, by talking trash against the Chinese government. No, you have to have really good terms and they will help each other out. Jack Ma has helped the Chinese government. The Chinese government will help Alibaba. That's why to this day, Alibaba and Jack Ma, they own a lot of the number one enterprise, air stocks in China. When you talk about e-commerce and payment systems and financials, the number one thing that they use over there, Alipay, and that's 33% owned by Jack Ma and Alibaba. When you talk about food delivery, Alibaba and Jack Ma, they own the number one food delivery service. To talk about car manufacturing, they have huge stakes in electrical vehicle startups like Neo and Kandai Technologies. So as you know, they're always there, and it's a good relationship between the two. And again, you can't get that big without the help of the CPC, which I think will continue to go strong. I think Alibaba, will be, a $1-2 trillion stock easily in 4 to 5 years. I think this was just, I think Jack Ma stepped out of line. I think he just stepped out of line. A couple of months ago, he was saying something about, oh, we don't need the Chinese government. So the Chinese government, threw their little lasso over to reel Jack Ma in and say, hey, we're still the boss here. We can do what we want to do. So if you don't oblige with us, we can run you out of business. So that's what I guess investors were fearful of, and that's why we saw a 20% plus correction in the stock market. However, I think this is really, really overdone. I think Alibaba is one of the best stocks in terms of e-commerce out there, even though it's a Chinese stock. So now let's talk about whether or not I will be buying this stock. So in terms of buying this stock, I'm very, very bullish on this stock. As you can see in the 5 years, it's gone up around 188%, which is comparable to other big tech companies like Microsoft and Amazon. I think this is a perfect opportunity to buy the dip. Overall, I think the stock market will continue to go up. I have bought heavily in my account around the 217, 220 range. So as you can see, it has recovered a decent amount, around 5% since when I purchased the stock. However, I still believe these prices aren't too bad. I started buying at 265. I dollar cost averaged down to around 217, 220. So my average price on Alibaba shares are around what it is right here, 238.50. I do believe that this will continue to grow up. I think this will probably be. I don't like giving price targets for specific companies, but I think this will easily be, another $300 stock in the coming days. So I'm not very surprised if I do see the stock recover all the way back in 2 or 3 months. But it's a very good stock, as I was saying. E-commerce, good growth. PE ratio is quite low. Right now, the PE ratio is around 25, especially for a big company. It's really good. 96% buy rating. And yeah, I think this is a very solid company. You should keep buying this. And yeah, thank you for watching. I hope you like my new setup. If you want more information, please let me know. If you have any comments, questions, please leave them down below. Thank you and have a good day.